Lesson: Financial guarantees and security mechanisms. Financial guarantees and security mechanisms are pivotal components in the realm of contractual agreements, particularly when addressing financial risks. These tools serve as protective measures, ensuring that parties involved in a contract can mitigate potential financial losses and maintain compliance with agreed terms. Their significance extends beyond simply safeguarding interests. They also enhance trust and facilitate smoother transactions. Understanding and implementing effective financial guarantees and security mechanisms require a strategic approach, leveraging practical tools and frameworks that professionals can directly apply to real-world situations. Financial guarantees function as promises or assurances that a debtor's obligations will be fulfilled. They serve as a protective buffer for the obligee, providing a safety net in case of default by the obligor. A common form of financial guarantee is the bank guarantee, where a bank promises to cover the debtor's financial liability if the debtor fails to meet contractual obligations. Bank guarantees are prevalent in international trade, where they replace the need for upfront payments and ensure that sellers receive payment even if the buyer defaults. The World Bank, in one of its studies, noted that the global issuance of bank guarantees accounted for over $50 billion annually, underscoring their widespread usage in mitigating financial risks. Implementing financial guarantees requires careful analysis and planning. A practical tool that can aid in this process is the risk assessment matrix. This matrix helps identify potential risks associated with a contract, evaluate their likelihood, and determine their potential impact. By categorizing risks, parties can decide which guarantees are necessary and what form they should take. For example, in a construction project, a performance bond might be issued as a guarantee that the contractor will complete the project according to the agreed specifications and timeline. The risk assessment matrix thus guides decision-makers in selecting the most appropriate guarantee to address specific contractual risks. Security mechanisms complement financial guarantees by offering additional layers of protection. These mechanisms often involve collateral or other forms of security interests that can be claimed in the event of default. A common security mechanism is the use of liens, which provide creditors with a legal claim to a debtor's property until a debt obligation is satisfied. Liens are frequently used in real estate transactions to secure loans, not ensuring that lenders can recover their funds if borrowers default. The Federal Reserve Bank reported that, as of 2022, liens secured over $10 trillion in real estate loans in the United States, highlighting their critical role in financial risk mitigation. A structured approach to implementing security mechanisms involves using a security interest checklist. This checklist serves as a step-by-step guide for ensuring that all necessary steps are taken to create and perfect security interests. It includes verifying the debtor's ownership of the collateral, drafting security agreements, and filing the necessary documents with relevant authorities. For instance, in the context of a business loan, the checklist would ensure that the creditor files a UCC-1 financing statement to perfect a security interest in the borrower's assets. This meticulous approach minimizes the risk of errors that could jeopardize the enforceability of security interests. Case studies provide valuable insights into the practical application of financial guarantees and security mechanisms. One notable example is the collapse of Enron in 2001, which underscored the importance of robust risk management practices. Enron's failure to implement adequate financial guarantees and security mechanisms contributed to its inability to meet financial obligations, leading to one of the largest bankruptcies in U.S. history. The aftermath prompted stricter regulatory measures, including the Sarbanes-Oxley Act, which emphasized the need for transparency and accountability in financial reporting. This case illustrates the dire consequences of neglecting financial risk mitigation and highlights the necessity of implementing effective guarantees and security measures. Professionals seeking to enhance their proficiency in managing financial risks must also consider the legal and regulatory framework governing financial guarantees and security mechanisms. Familiarity with relevant laws and regulations is crucial for ensuring compliance and avoiding legal pitfalls. For example, the Uniform Commercial Code in the United States provides a comprehensive framework for creating and enforcing security interests. Understanding the UCC's provisions, such as those related to attachment, perfection, and priority of security interests, is essential for professionals involved in drafting and executing secured transactions. Similarly, international trade professionals must be aware of the rules established by the International Chamber of Commerce, such as the Uniform Customs and Practice for Documentary Credits, which govern the issuance and handling of letters of credit. Practical tools, such as legal compliance checklists, can aid professionals in navigating the complex legal landscape. These checklists outline the key legal requirements for different types of financial guarantees and security mechanisms, ensuring that all necessary steps are taken to achieve compliance. For instance, a checklist for bank guarantees would include verifying the guarantee's terms, ensuring it meets regulatory standards, and confirming the guarantor's financial stability. By systematically addressing legal considerations, professionals can reduce the risk of disputes and enhance the effectiveness of their financial risk mitigation strategies. Statistics further illustrate the growing importance of financial guarantees and security mechanisms in mitigating contractual risks. According to a report by the International Monetary Fund, the global market for trade finance, which heavily relies on guarantees and letters of credit, was estimated at $9 trillion in 2021, highlighting the critical role these instruments play in facilitating international trade. The report also emphasized the increasing demand for digital solutions in trade finance, which streamline the issuance and management of guarantees, thereby reducing costs and enhancing efficiency. This trend underscores the need for professionals to stay abreast of technological advancements and incorporate digital tools into their risk mitigation strategies. Digital platforms and software solutions offer innovative ways to manage financial guarantees and security mechanisms more efficiently. For example, blockchain technology is being increasingly adopted in trade finance to enhance transparency and security. By providing an immutable ledger of transactions, blockchain reduces the risk of fraud and errors, ensuring that all parties have access to accurate and up-to-date information. A study by Deloitte found that blockchain has the potential to reduce trade finance operating costs by up to 50%, illustrating its transformative impact on the industry. Professionals can leverage blockchain-based platforms to streamline the issuance and tracking of guarantees, improving the overall effectiveness of their financial risk mitigation efforts. In conclusion, financial guarantees and security mechanisms are indispensable tools for addressing financial risks in contracts. Their implementation requires a strategic approach, leveraging practical tools and frameworks such as risk assessment matrices, security interest checklists, and legal compliance checklists. Understanding the legal and regulatory framework is essential for ensuring compliance and avoiding legal pitfalls. Case studies and statistics underscore the significance of these tools in mitigating contractual risks and highlight the growing importance of digital solutions in enhancing efficiency and reducing costs. By integrating these strategies into their practice, professionals can effectively manage financial risks, safeguard interests, and foster trust in contractual relationships.